Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review, recording this late Friday morning on January 3rd. Happy New Year to everybody. Hopefully you have a great holiday season, and now we're back at it. So we came into the new year relatively cautious. We're about half in cash in Cabot Growth Investors model portfolio. And I still think that's the right move for now. I mean, December was a pretty rough month. The best stat that I saw that sort of gives you the broad picture, the S&P 500 equal weight, so the big cap stocks, the major index, but just on an equal weight basis, lost about 6.5% in December. So it was a pretty rough month. And right now, the intermediate term trend of most indexes and stocks is we call it down. You could say it's neutral, but it's not up at this point, really, no matter what you're looking at. Okay, and some stuff is clearly down, and a lot of growth stocks are just, even the ones that are resilient. They're not really going up. They haven't gone up for a month or so. And some of the worst ones obviously have really taken hits. Now, the good news is, because December was sour, sentiment, which had been exuberant, has come down somewhat. I'm not going to say it's, people are super fearful. And we are seeing more, some oversold stuff. I'm not a big overbought, oversold guy, but some oversold stuff is popping up. Very few stocks are hitting new highs day after day after day after day, which after, for a day or two doesn't mean much. But if it happens over 3 weeks, 4 weeks, it's something that usually occurs near intermediate term lows. So we are seeing some of that, and we are seeing some leading stocks pull into logical support areas while others are building bases, basically. Some of them are 6, 7, 8 weeks. Some of them are 3 or 4 months. They kind of sat out the dance more recently. So I am very flexible, and listen, we're half in cash. I'm not going to be fully invested next week, but if we did see some breakouts, I'd probably put some money to work. If those breakouts started working, we saw more positive action from the market and leading stocks, I'd put more money to work and kind of go like that into earnings season. Early January is always tricky, so I'm not reading too much into the first, 2, 3, 4 days, but that's kind of where we're at right now. Not to use an overused phrase, but I think the onus is just on the buyers to kind of step up, get some stocks moving to the upside, get the indexes back above 50-day lines, that sort of thing, for us to put money back to work. Okay, let's hop into the charts as usual. I'm using a program called Market Surge. It's a product of Investors Business Daily. You can learn more at marketsurge.com. As always, just starting with the indexes. The NASDAQ is the strongest one. It hit the 50-day line yesterday, so January 2nd, and is bouncing so far today as I record this. So, on this basis, the intermediate term trend, I guess, for this one is still positive. But when you look at just about everything else, it's either neutral, like say the S&P 500, a little bit below the 50-day line here. You could just kind of say it's sort of sideways here for the past month and a half, ballpark. And then of course you just look at the broad market, much weaker. This is the IWM, has been bottoming out here a little bit. I would note that small caps, a little bit of outperformance after really getting hit hard the last couple of weeks. So, maybe that's a sign of something. But clearly below its moving averages on an intermediate term basis. MDY, same sort of thing, bottoming out, but still kind of buried. New York Composite, pretty much the exact same picture. And just if you look at a lot of things, so I'm trying to pull up, just here's like XLF. These are financials. Again, it's not 2008, but after a pretty big run here, really since August, now we're kind of breaking the 50-day line and living below it a little bit. Now maybe you get kind of a resumption pattern here if some of these things get going on the upside, but just taking the evidence for now, like I said, it's kind of on the buyers to step up. KRE, which is sort of the regional banks, that still looks pretty weak actually. IBD 50 index, this is the growth measure, just kind of below the 50-day line, not a complete horror show, but just again, weakness. The equal weight, NASDAQ 100, a lot of stuff. Basically what I'm trying to say is, if you look at a lot of charts, most of the market, the vast majority, looks like this chart, which is not exactly, but I had a big run into early December, late November, started to slide and then broke the 50-day line, and then it's been kind of going sideways since. You could say this is a low, but we start breaking down from here, it looks pretty weak. So again, intermediate term trend mostly down. Now I would say on the positive side of things, we aren't seeing, and I said this a couple weeks ago or last week, I think, we're still not seeing any rush into defensive stocks. Now, maybe that's because of interest rates or the dollar, which I'll talk about in a second, which is probably the only time you'll ever hear me talk about the dollar. But you aren't seeing, this is XLP, you're not seeing any rush into defensive stocks. at all. This is, healthcare is kind of dancing to its own drummer, of course, with some regulatory fears. But, even the utilities here picking up a little bit this year, but again, certainly not, greatly outperforming the market to any real degree. So, it's been pretty much everything except for some mega cap stocks has sold off. How that plays out, is that just sort of the pause that refreshes? If so, we'll put some money to work. If it's sort of the beginning of some sort of corrective storm that takes not just 1 month but 2 or 3, we'll stay in a lot of cash. Okay, just to keep an eye on things. This is UUP. Well, actually, this chart. Well, okay, I didn't check this beforehand. So if you look at this on stock charts, it looks different. This is sort of a dividend that's not adjusted. But take my word for it that the U.S. dollar since the start of October has been straight up, partially because interest rates, this is a 10-year note, remain very resilient here and really aren't going down at all. So whether that's because of inflation or growth or whatever, it's having an impact on the broad market. So, right now it's a little bit too easy to say, well, if interest rates go up, the broad market's going down. But that's kind of what's going on. Maybe not on a day-to-day basis, but sort of on a week-to-week basis. So that's kind of what we're watching here in terms of secondary evidence. Now, so top-down evidence, I would say mostly negative. Bottoms-up evidence, also more negative on an intermediate-term basis. But we have seen a couple of things. So first, I mentioned, and this isn't the best chart, but this is what they have on Market Surge. This lower panel, this is very messy, but this is sort of market indicators, New York Stock Exchange base. So if you look at the lower panel, it's blue and pink, the very low panel. The blue line is a 10-day moving average of new highs. I even look at 15 or 21 days, like I was saying earlier. But if you could go back, it's basically at levels that are near corrective lows. Can it go lower? Yes, that's the thing with these oversold things. They can always go lower, they can stay down. Okay, but we are, every day that goes by, that's kind of, very few new highs. To me, it's sort of a sentiment measure. Obviously, there's not a lot of buyers that are willing to, push things to new highs, which tells you something, okay? So we are seeing some of that sentiment. And we are seeing a lot of stocks I'm seeing that are pulling back normally into support. I'm not talking plunging into the 50-day line, but just sort of easing into support and could provide either, initial buying opportunities, maybe on a smaller basis, or, if you already own it, maybe add on a little bit. Depends where you own it and how aggressive you want to be. But this is CRDO, CRDO, certainly still relatively extended, but the moving averages are catching up, and it gapped up here. I think it was literally the last day of November or something like that. Huge hike in the outlook. Everything was huge. And it's basically just sat still since then, okay? And now the 25-day line is caught up. So let's see what happens. To me, it looks like a decent setup. Of course, you got to kind of be flexible and nimble. And if the stock breaks down from here, you don't want to sit with some huge loss. But pretty good setup here. And just notice how it's gone sideways here. Again, it's not like it gapped up and then did this and the 25-day line, caught up. It's sort of gapped up and just been doing this while the moving averages have caught up, which is more, kind of more what you want to see, okay? Rubric, similar sort of thing. Obviously, it's gotten, these things have, shaken out, don't get me wrong, but Rubric had a huge run, breakout at 40, almost doubles here, and it's pulled back to the 25-day line. Is that enough? Maybe not. But overall, like on the weekly chart, it had this huge thrust, and you just look at the last 3 or 4 weeks, it looks pretty normal in here. It did have some selling volume a couple of weeks ago, 3 weeks ago. So, not ideal, but given the environment, given the market, it certainly doesn't look abnormal, and in fact looks pretty proper to me. Might need more time, but certainly something to watch. TWLO, TWLO, it's had a huge run. This is kind of a turnaround name, more of a cost-cutting name. Beautiful, look at this tight area, by the way, just to go on a tangent, but beautiful base breakout on earnings a couple of months ago. Huge run. And again, now on the weekly chart, you just have this 4-week zone in here, very tight. And again, the moving averages are, the 50-day line now is coming up toward 100. Stock's at 111. So it's not like it's super extended. It's not, pristine. But so this is another name. I'm not going to tell you, say, oh, it's a great buy above this or down here. You can decide on that. But just overall, a pretty good setup. DoorDash, a little sloppy in here, but we're seeing it, this day right here was a little sloppy, and the fact that it hasn't bounced back isn't the best sign. At the moment, though, I'm still interested in it because of something I've mentioned here, a few times. This was a nice base breakout back in October, I want to say. 9 weeks up in a row, most of them peak closes, and then it really hasn't, it's 5% off its high. So you can talk about 50-day lines, which are important. They're very important to me. But, it's 5% off its high. It's not, it hasn't done anything wrong. The stock was at 140, went to 100, and then went to 180, and now it's at 170. So, that looks pretty normal to me. It's one of these, like, can you get some resumption pattern, whether it's out to new highs or just a couple of big volume days that, maybe with the rest of the market that say, okay, the correction's over, basically. Because so far, that's what it looks like, is just sort of a normal rest period. And then all these are kind of resumption patterns, meaning they're up, they've paused, moving averages have caught up or whatever, and now they might resume. Okay, Vistra is same sort of thing. This is your utility, AI sort of utility play, right? VST. Now this one has this one has had a huge run. So, at some point the rug will get pulled on a longer term basis, no matter how good the story is. But that time doesn't seem to be now. It's had a, kind of a correction here, and then it rallied, and another correction here. So it's a little bit of a base on base. But again, this is sort of a little sloppy, but then comes to life here. Decent volume yesterday. It's looking, as I record this, like it's going to be pretty heavy volume today, obviously acting well. So that's kind of an interesting sort of resumption pattern from here. Again, early January, tricky, not to keep putting caveats out there. So, sometimes these things can wobble up and down the first 2, 3, 4, 5 days of the year. But so far, so good on that. On the base breakout things, so here's GE Vernova, which I'm going to pronounce correctly from now on. It looks it looks very good. If anything, maybe if you're looking to buy it, maybe you wish it had a bigger shakeout to shake some people out. But it looks like the relative strength line, the RP line, is out to new highs or close to it. 350, 355 has been a wall, or ceiling anyway. So we'll see how that goes. But overall, nice pattern. Chip stocks, I keep mentioning these. So this is Taiwan Semi. It's kind of easier to see in the weekly. Here's kind of your initial base after the August mini crash or whatever you want to call it. And now here's your sort of tighter base, and the stock is really kind of tight in here. Of course, things do tighten up near year end, but it's really tight in here on a percentage basis. And, can it get going here? I'm also going to mention NVIDIA. I do have to say this does look a little, this whole thing right here after such a huge run does look kind of sloppy, but it's kind of got that in Taiwan Semi look where it's got this sort of messy base. This looks kind of toppy, no real buying volume, but then all of a sudden we got some buying volume a couple of weeks ago, and this whole pattern, go to the daily chart because this whole pattern here, there was 150 resistance after earnings. But it's pretty tight in here the last couple of months. The eye has kind of come off of it. It's popping back above the 50-day line, which isn't that important during a base. But so we'll see how it goes. But it's just something I'm keeping a distant eye on. Could it resume and have another run? Yeah, sure, why not? And it does really have. At this point, this was back in June. So it's been 6.5 months, I guess, of no net progress for NVIDIA. So it might have put in enough time. We'll see how it goes, okay? But some chip stocks is the point. Appfolio, this is one we were watching earlier this year. This is APPF. It looked like it was getting going here. Never really did, and then it's been sloppy. So speaking of no net progress, this hasn't gone anywhere for months and months and months. But you can kind of see here on the daily chart, it collapsed in here, but it's had a nice run in here. It has pulled back with the market, but normally. So we'll see how it goes. It's a little bit of a thinner trader, so it has these exaggerated moves. But this would be something where you're looking at probably some sort of more traditional breakout down the road. Just a couple more for you. So BIRK stock, I think I mentioned this, BRIK last week. So it has pulled back with the market, of course. But again, just kind of on the weekly big picture, it got hit, kind of like Appfolio, has come back. Now it's pulled back normally. So the question is, has it completely changed character? It looks like it, but you kind of have to wait for confirmation from the market and all that. And then last but not least, keep an eye on some of these other areas that, I'm all for growth, but growth had a great year last year. I have a webinar coming up. I'll talk about it. Usually the next year becomes a little bit more stock picking. I hope I'm wrong. I'd love for it to be another year like last year, so just keep an eye on some other areas. One thing that I just noticed is natural gas stocks. Prices are up, so it's all, it's a commodity stock. It's not going to be my favorite. But you do have this is Antero Resources AR, kind of a classic cup with handle if that's your thing, but a classic launching pad in here. And then kind of a breakout attempt this week. Maybe it's not, working as, I guess it's down today, but, so we'll see how it goes. Or I guess a classic breakout attempt, this week, earlier before the New Year's. So it's hanging in there pretty good. Range Resources is another sort of natural gas play in here. EXE. is called Expand Energy, which used to be Chesapeake Energy. I think they just changed their name and nothing else. But you're going to see these things have been kind of dead as a doornail for a while. And some of them have changed character here in recent weeks, tightened up. And this one probably looks the best, Expand Energy, testing sort of 100 round number resistance. So there are some other areas of the market that might perk up, okay? Back to the indexes. We'll look at the NASDAQ here. This one looks pretty normal. What we're really looking for from here on out is pretty simple. Can the strongest index, which is the NASDAQ, growth-oriented, rally from here? Can the rest of the indexes come along for the ride, not just the NASDAQ? And most importantly is, can some of these individual stocks get going and bounce off some of this major support and provide some add-on entries or some fresh, maybe smaller entries? For now, I'm cautious. Small new buying, holding plenty of cash, pretty nimble. If you buy something that doesn't look good a week later, maybe you're jumping out sort of thing. Not really a ton of confidence. But if you get a couple of these things, this is rubric, but if you get a couple of these things to really thrust higher for a day or two, the NASDAQ acts well, volume is good, things are taking out some resistance for the first time in 4 or 5 weeks, I think that would be a sign to start putting a little bit more money back to work and then take it from there. Okay, that's all the time I have for today. As always, thanks for watching. Be sure to come by again next week for another Cabot Weekly Review.